Many of you have asked me for an update on SOFI stock. The stock is down 37.5% year to date. But very recently, we had the popular Muddy Waters Research short report. It got a lot of attention on X, and the CEO went on CNBC today and he talked about the short position. And I did watch the interview and I did read the report. I have to be honest, there's some things I kind of agree with him on, and I'm a SOFI shareholder. I agree with him on a few things. But there's some things I disagree on, and I believe he overstated the potential impact of the underlying accounting, you could say, adjustments that he talked about. So I'm going to talk about those things today, and I really hope you enjoy it as always. Now, this report again got a lot of attention on X, and a lot of people were commenting on it. And I just have to be honest, SoFi has some kind of a, you could say, cult following. Same thing with HIMS, same thing with Tesla, which means, if you say anything bad about the stock, even if it's potentially true, you get mocked and you get people say all kind of names about you. But I don't personally do that. But the main reason why a lot of shareholders were upset is because the publications of the report begins with Muddy Waters stating that they intend to cover substantial majority or possibly all of their position as soon as the report comes out. And as soon as it came out, maybe they covered, maybe they didn't, but the stock went down 6 or 7%. And then he talked about it on CNBC, and he has out of the money put options. So we don't really know what kind of position he has, but I'm going to focus a little bit more on the short report and what he said rather than other kind of things. Now, the CEO did respond by buying a lot of shares. He bought like 500,000 worth of shares. And a few days ago, he bought $1 million worth of shares. That adds some confidence. The company itself has responded to the report. They said that the report demonstrates a fundamental lack of understanding of our financial statements and business. They said they intend to explore potential legal action against Muddy Waters for the faculty inaccurate and misleading report and things like that. And that's really not a bad response. But for me, as a SoFi shareholder, I would have loved the company to go through every single point that Muddy Waters has highlighted and tell them, okay, this is what they said, this is why they're wrong. Number two, this is what they said, this is why they're wrong. This is what I would love for them to show me. And that would help me gain much more confidence than the CEO just buying back stock. And Muddy Waters said that he's buying out of his bonus, which he used accounting methods to inflate the stock price to get the bonus. And the percentage of the money he purchased from the bonus is pretty much meaningless. And, maybe he has a point over here. But again, I would have preferred SoFi to address each point and tell me why they're wrong instead of just saying they're like fraud or they're whatever. I mean, that's what I would have preferred. But after looking into the report, the main point that I want to cover, and I'm going to try to make it as simple as possible, and this is mainly the fair value changes in the loans held for investment. This is the cash flow statement. In the cash flow statement, the first line is the net income. SoFi generated $481 million in net income. We adjusted back $351 million in the cash flow statement, which means the earnings report, the income statement, included a $351 million gain, you could say, in fair value of the loans held for investments. Now, if we take the $351 million out of the net income of $481 million, net income would have been around $130 million for 2025. This is really big, and this is why Muddy Waters claimed that if those things are true and they could prove them or whatever, it could affect the company's EBITDA by about 90%, which I believe is a little bit extreme, and I'm going to tell you why. Now, in terms of the fair value of the loans held for investment, it's a little bit complicated, but SoFi has personal loans, it has student loans, and it has home loans, okay? Now, the personal loans and the home loans, they don't actually hold them as an investment on the balance sheet. They kind of hold them for a while, and they want to sell them as soon as possible. They don't want to hold them on the balance sheet for the long term. The student loans are the loans that they want to hold them on the balance sheet for the long term, okay? Now, when those loans are on the balance sheet, SoFi has to adjust what they believe is the fair value of the loan. This fair value is determined by the average credit score score by if the underlying borrowers are 30 days late, 60 days late, 90 days late. If the discount rate goes down, those kind of loans could potentially gain in value, meaning if interest rates come down, or if other things happen within the borrowers or within interest rates in general or the credit profile of the borrowers, they could either raise the fair value or decrease the fair value as a loss or increase it as a gain. They can do that. Now, there's nothing wrong with doing that for a loan that they're about to sell. Because let's say, for example, they raise the fair value of the personal loans by 200 million and they sell them for the amount like 100 cents on the dollar for the fair value, then we're gonna see the gains on the income statement. There's nothing wrong with that. But what they did with the student loans is they increased the fair value adjustment on loans that they are really not intending to sell. So they intend to kind of hold them for the longer term. Now, because they're holding them for the longer term and they're putting up that they increased in value or the fair value got adjusted upward, this is like they're recognizing a gain on something that they don't really plan to sell. And we don't really know if they can actually get this fair value amount if they want to sell those loans. So maybe it's a little bit technical, but this is kind of what's really happening with private credit. I'm not saying SOFI is like that, but with private credit, the banks are not involved. Those kind of institutions like BlackRock and KKR, they hold those loans on their balance sheet, okay? They mark them at whatever they believe is fair value. Could be maybe 100 cents on the dollar, but the borrower is not paying. And you don't know that until you get outflows and the company has to sell those loans on the open market. Then you know what the actual fair value of the loan is. So in this case, SOFI is kind of increasing the fair value, you could say, of loans that they don't intend to sell, and they recognize the gains, which kind of inflates net income a little bit. And we don't really know if this is the actual fair value of the loans or not. This is the simplest way I can explain it. And if we look at here, it says cumulative fair value adjustment. So we don't really know by how much they raised it or they adjusted it this year in 2025 or this quarter. This is cumulative over the life of the loan, which again, you have some loans that come off the balance sheet and some of them mature. So it's really hard to know what is the percentage that was adjusted, let's say this quarter or this year or however it was. It's 723 million. Last quarter, it was 635 million. So they pretty much been adjusting it upward. Same thing for personal loans and same thing for home loans, although it's not as extreme. Now, this fair value adjustment, based on my research, accounts for the fair value of change for the long term, which means it accounts for all of those three in terms of fair value changes that affected earnings. Now, based on the total loan book, which is about 33 billion, 11.8 billion of it is in student loans, which they mainly hold them for the long term. Now, the 11.8 billion out of 33 billion is about 37%. So 37% of their total loans are about student loans or held for the long term. And this is, again, not a perfect calculation, but I'm going to show you what I did here. If I take the 37% out of the 351 million that was used for the adjustments to adjust for the student loans only, and we take in 37%, I get about 129 million instead of 351 million. And if I take it out of 481, I get about $351 million. So there was about 130 million, you could say, positive impact to net income in 2025. And they said it on CNBC. That's not really illegal. I mean, the company can do it, but it's more of an accounting trick, you could say, that has helped net income very much in 2025. Now, that might be a little bit concerning, but the good news is that SOFI doesn't really need those kind of fair value measures on student loans for them to have a little bit better than expected net income. And if they wanted to be more profitable, they could really do it anytime. This is a little screenshot from the latest income statement. They have 771 million in net revenues. They're spending 156 million on just development and research and development. So that's not really necessary. Like, it's not like the business is gonna die if they don't spend 156 million on it. Then they increase their sales and marketing by a lot from 167 to 238 for them to grow the business further. So if the company, let's say, wanted to be a little bit more profitable, they can keep the sales and marketing at 167 million, save about 70, 80 million dollars. They can cut the technology and product development expense, and they can put up around 200 million, and they can show more profitability right now. But they're not really doing it because the CEO is really focused on the long term. So this is really technical stuff, you could say. And no matter how much I research it, Muddy Waters research it, it's really hard to know the exact details. But based on my understanding, this is the kind of biggest concern, is that the company is using those fair value adjustments to kind of inflate earnings per share, adjusted earnings per share for 2025. But I showed you that even without those, if the company wanted to be profitable, they could really be more profitable tomorrow. And you could say this is a concern, and I would say it's a concern. But if the stock was still trading at like $30, $31, I'm like, yeah, that's a big concern for the current valuation. But the stock is down like 38%. It's trading below a 1 PEG ratio, with the CEO guiding about 40% earnings per share growth for the next 2 years. So that's a big difference. So I believe a lot of it is kind of priced in the valuation. If it was still trading at $31, my reaction would have been entirely different. But I think a lot of it is kind of priced in the valuation. Now, I even ran it through Claude and ChatGPT just to get a second opinion. And they kind of agreed with me. And their own worst case scenario, like if every single point that Muddy Waters talked about is 100% true, like if all of them hit, which based on my research is not even true, but based on his research, if all of them are actually true, it could impact the EBITDA by 90%. But even Claude is telling you maximum, like absolute worst case scenario, is a 30 to 50% haircut on EBITDA. And it's about, again, what I calculated of about 37% hit on net income. But again, it's not really a hit because we don't know, you could say, what percentage of this fair value adjustment is true and what percentage of it is not true. So let's say we said 37% is due to the student loan adjustment, but maybe half of this adjustment is actually well-deserved, and maybe the other half is not as well-deserved. So it's even maybe less than 37% impact. So I would say that's a pretty interesting one. I would believe, Muddy Waters is right on this one. I think he's wrong on a few other points. I think he's wrong on the 90% EBITDA reduction. And you have to remember that those kind of reports are governed and looked at by the SEC and by a lot of agencies. And you have to know that even if you read it on the income statement, SOFI uses a certain method for adjustment of fair value, and there's a third-party company that determines SOFI's fair value, and then they kind of compare them together. For example, the third party against SOFI, and they see which one is more accurate to come up with those fair value adjustments. So the CEO is not like waking up tomorrow and say, okay, we're going to adjust it at that much and inflate earnings per share. The SEC is looking at that stuff, and there's a third-party company that's also rating those loans, and they combine it with the results of SOFI for their fair value, and they look at them together, and all those things are being looked at by the agencies. So again, I don't believe like this is, I don't know, like a hims and hers risk where they're doing something illegal and they're going to get sued and the stock's going to go down. It's not really that much. It's more of a fair value accounting kind of a trick, you could say, that affected the earnings per share positively in 2025. They even said it themselves on CNBC. It's not illegal. The company could do it. A lot of companies do it. If it was still trading at $31, $32, and I did trim some shares back then, I made this video and I got a lot of hate. But if it was still trading there, I'm like, you know what, that's a little bit too much for the current valuation. But if it's now trading at 17 times with such growth and with a really good CEO, I mean, you have to trust the CEO at the end of the day. If you're investing in a complex company like SOFI or Constellation Software, I mean, I think a lot of it is priced in the valuation. But that's my opinion on SOFI, the short report, and everything around it. Hope you enjoyed it. Hope you got some value. If you agree, disagree with me, let me know down in the comments. Thank you for watching again. Was not financial advice. If you did enjoy it, again, press the like button. Maybe consider subscribing, and I'll talk to you in another video.